Nigeria has the critical minerals the world needs. The world knows it. The question is, do we? Hello and welcome to another power-packed edition of Business Week. This week, Washington just blindsided the European Central Bank selling euros to prop up the yen without telling the ECB. That's the first joint US-Japan currency intervention in nearly 3 decades. Then still in the US, the jobs report landed like a bombshell. The world's largest economy shed 23,000 jobs in July when markets expected it to add 80,000. The Fed's rate path just got a lot more complicated. And over in Central Africa, Congo is tightening its grip on copper and cobalt, banning concentrate exports to force domestic processing, and markets immediately noticed with copper jumping 1.8%. Here in Nigeria, the country unlocked a fresh $3 billion in liquidity through Project Gazelle 2. NNPC's upgraded $4.5 billion pre-export facility, while OPEC Plus adds more oil to a market already nervous about demand. The Johannesburg Stock Exchange is actively courting a Dangote refinery secondary listing, Africa's largest boost market, a direct play for what could be the continent's most significant industrial IPO. Saudi Arabia's PIF completed its $55 billion takeover of Electronic Arts alongside Jared Kushner's Affinity Partners and Silver Lake, as Riyadh's ambitious stretch well beyond oil into global entertainment. And perhaps the most Nigerian statistic of the week, our people spent 1.41 trillion naira on beer, malt and spirits in just 6 months. Later, the man who built Nigeria's mining license system from scratch, Professor Ibrahim Garba, joins us live from Kano to ask the harder question: do we have what it takes to stop exporting and mineral wealth raw and actually capture the value locally? If you missed any of the big business stories this week, don't worry, I've got you covered as always. I'm Rolake Akinkunwe-Filani. Stay tuned. As always, we'll start with a look at global energy commodities, with crude oil posting steep losses as investors assess improving supply expectations and easing concerns over potential disruptions to global energy flows. Natural gas also ended the week in negative territory. So on a week-on-week basis, Brent crude declined 6.93% to $83.69 per barrel. WTI crude also fell 7.06%. Natural gas eased 1.85% to $2.66. And RBOB gasoline dropped 7.14% to $2.99. Let's come to our domestic equity markets. The Nigerian stock market delivered a mixed performance during the week. On a week-on-week basis, the NGX All-Share Index edged up 0.12% to 245,577.97 points. The number of deals fell 24.46%, while trading volumes jumped 52.71 to 1.44 billion shares. Market turnover did decline by 45.9% to 25.2 billion naira, while equity market capitalization rose by a mere 0.12% and at 158.51 trillion naira. Let's look at Africa now. African equities did record a mixed performance over the week. South Africa outperformed every other person, while Ghana, Kenya and Morocco closed lower amid profit-taking and cautious investor sentiment. Let's scoot over now to global stock markets. Let's look at what's happening in Europe. It was a green all-clear sweep on the Euro Stock 600, which rose week on week to 1.71%. FTSE followed 0.3%. DAX up 2.83%. CAC 40 Paris was also up by 2.41%. And of course, IBEX 35 in Spain was up by 1.9%. Wall Street had a pretty good week also. Dow Jones index was up by 3.02%, but the Nasdaq Composite was the outperformer here, rising week on week by 5.58%, thanks to those tech stocks always doing brilliantly in and out of season, regardless of what happens in between. Let's go to the wall now for my top picks from the week. What do we have here? Well, I want to start with the news that for the first time in almost 30 years, the US, the Fed and the Central Bank of Japan were collaborating, but there was one party that wasn't happy with that collaboration, and that was the European Central Bank. Why wasn't it happy? Well, the yen has been struggling lately, and the US thought we'll assist our brothers over in the East. So what the US did was that it sold billions worth of euros and bought Japanese yen in order to support the yen, because we're seeing the yen fall significantly. Interest rates have been quite low as well. Now, that was a bit surprising because the expectation was that the US would sell US dollars to prop up the yen. But of course, US Treasury Secretary Scott Bessent is keen on maintaining a strong dollar, especially heading into midterm elections. And so the challenge for the ECB is, you should have told us you were going to sell euros and not just sell euros. And of course, ECB President Christine Lagarde wasn't very happy that this happened. It's the first time we're seeing such intervention between the US and Japan without the involvement of the other major central bank in Europe, the ECB. Now, the US was probably concerned because the Japanese are one of the largest holders of US government treasuries and could have opted to sell those treasuries to get liquidity to prop up the yen. And if we know anything, we've been following the story in Japan. Japan has actually expended almost 100 billion in July alone to try and defend the currency. So, of course, ECB not very happy. This is quite unprecedented because historically, since the end of World War II in the late 1940s, that collaboration has been watertight, a sort of gentleman's agreement, and this is the first time it's been violated. But we also see that we're seeing quite a bit of arbitrage there between the interest rates in the US versus the Japanese interest rates, which are currently at 1%, had been historically negative and at all-time lows. So interesting development there with global FX coordination across the board. Let's look at my next top pick from around the world. Well, the next top pick here is that the Gabon dollar bond return hit historic highs for emerging markets. In fact, not historic highs, but it was the best performing emerging market in the first quarter of this year, with a dollar bond return of 10.2%. And actually, the number 2 emerging market hard currency sovereign performer as well this year. The EM benchmark was minus 1.3, Gabon there yielding about 10.2%. And the big driver here was an expectation by markets and investors around the type of deal that the Gabonese government would strike with the IMF in order to try and really shore up its currency. But it's a bit of a challenge here because Gabon is still facing some fiscal headwinds. And if this IMF deal doesn't actually work out in the medium term, we could see some risks to that dollar bond return. But so the key here is debt above 70% of GDP is where we're going. Gabon is already scratching that threshold already. So we'll be seeing in the next few weeks how that really evolves. And the government could actually tap into up to 1.5 billion in new international borrowing under that IMF program. So still a high risk situation, but the dollar bond returns suggest that investors and markets are buying into the potential for a deal to be struck between IMF and Gabon. Let's look at my next top pick from around the world. And this is a report, interesting dynamic going on here, that Africa's startup funding in the first quarter of this year has leaned more towards debt rather than equity. Now, in the first quarter of 2025, we saw the split of startups were tapping into equity markets, private equity at 85%, venture capital, and debt was at 11%. Now, come Q1 2025 this year, both financing instruments are almost at par, with startups securing 51% in debt and 49% in equity. Never mind that volumes of financing for startups in Africa have dropped anyway. What this seems to suggest is that many investors are not wanting to take that early stage growth risk, which you typically require equity for, but are looking for cash generative companies and assets to do business with and benefit from regular returns actually via interest rates. But this also signals a growing pool of private credit, private debt in the African startup market. So 80% of funding for startups in Africa in May was debt. But that also comes with its risk because you have to borrow at reasonable costs that you can service over time, obviously. So look at the numbers there. May funding, $235 million. And we saw a tanking in May funding alone to $54 million when we compare 2025 to 2026. So some headwinds there for startup financing in Africa, notwithstanding the fact that debt is featuring more on that capital slate. Let's look at my next topic around the world. I mean, this shouldn't come as a surprise if you've been following the African minerals story, and it's going to be at the heart of our deep dive discussion later in the show. But the DRC has actually banned the exports of copper and cobalt concentrate. Important distinction here, because the concentrate means that the country is trying to get more local processing and local value addition within its borders. And in fact, at one point, the government had imposed a total ban on the exports of copper and cobalt, but has now introduced quotas. The ban on concentrates can occasionally be lifted if the government feels there is a strategic reason to doing so. So the copper market reaction, what we saw, obviously, if you pull back supplies, prices go up. Prices did shoot up by 1.8%, specifically in the copper market. And this is part of a broader drive we're seeing across sub-Saharan Africa by governments to drive more local beneficiation. In other words, local processing of minerals before they are exported. Now, the final story here on the topic is the surprising news that the jobs picture in the US is not looking so great. We're just a couple of months away from the midterm elections. This is not something the Trump administration will want to hear. But July jobs report indicated that the US economy lost 23,000 jobs. Now, analysts and market expectations were that the economy would gain by 80,000 jobs. So that's an actual 23,000 loss and 100,000 jobs prediction missed in total. The interesting thing, though, which might seem like a contradiction, is that unemployment fell from 4.2 to 4.1. So how do we explain that? We lost 23,000 jobs, but unemployment actually fell. Well, according to the data, what they're seeing is that a fewer number of Americans were recording themselves as unemployed. So it's really around the reporting of the data rather than the actual data in itself. Now, you're probably wondering, what does all this mean? But let's go to the Fed, because this is really where the rubber hits the road. Now, the Fed was anticipating a potential rate hike at its September sitting. And if you know anything, central banks around the world are all about price stability and maintaining unemployment. Now, the constant tussle between inflation and unemployment. Now, if the jobs market is not looking great, then the impetus to hike rates may not be there as much. So the big driver and watch for us and for those who are following US monetary policy and economics is the Fed rate decision. This particular statistics has huge implications for that. We'll be watching here on Arise News.